Hello, I am Addison Morris with the Women's Cannabis Chamber of Commerce, and this is Clip Notes with Angelita Green, the founder and CEO of New Leaf EA. This is the third in Angela's series. The second in Angelita's series of 4 accounting themed cannabis clip notes series. Angela has over 20 years of experience in accounting and management. She's a certified DopeCFO VIP and has worked with cannabis clients for over 9 years from seed to sale industries. She's a certified seed counter. New Leaf EA specializes in cannabis cash management, Cannabis KPI, Cannabis CFO services, cannabis inventory management, cannabis startup, cannabis tax planning and tax preparation, GAAP, cost accounting, 280E, and tax compliance for all segments of the cannabis industry. So, Angelita, can you talk a little bit about tax strategies? What's tax planning? Tax planning strategies. How do you define that?
Sure. Let's see. So I have a slide here, and I'm not sure. Let's see my presentation. This is actually the Clip Notes Series 3 of 4. And we'll be talking today about the cannabis tax planning strategies. And let me dive right on in. So, welcome everyone. Today, we're going to explore the critical components of cannabis tax planning. It's more important than ever for cannabis businesses to stay informed and adaptable amidst a rapidly evolving legal landscape. Efficiently navigating taxes is key to just not survival, but success. Section 280E of the IRS Code presents unique challenges as it limits standard business deductions for cannabis companies. Understanding its implications born from historical context is essential in tax planning. In my Clip Note Series 1, I discussed a little bit about 280E. So if you want to go back and look at that one, it'll be available, I believe, at the beginning of the year. So optimizing cost of goods sold is pivotal for managing expenses under the constraints of 280E. Accurate bookkeeping here is vital, along with digital solutions. So digital solutions would be like, document management, being able to, upload your documents digitally. To keep your records organized and up to date in real time. So let's look at each vertical and some categories that may help to optimize your cost of goods sold. So for cultivators, accurate expense categorization, if I can get that out, cultivators should focus on categorizing expenses related to like raw materials, cleaning, curing, packaging, trimming, direct labor, and indirect costs as cost of goods sold. By ensuring each of these costs are meticulously documented, cultivators can optimize their tax deductions within the legal constraints. Manufacturers' production cost monitoring. For manufacturers, tracking every element of the production cost is crucial. This includes expenses for raw materials, equipment depreciation, and direct labor expenses, indirect costs involved in the processing. This proper classification helps in maximizing cost of goods sold deductions. Retailers, although they don't get as much as the other ones, inventory and direct costs. Retailers need to focus on precise inventory management and accurate categorizing of invoices of direct product less any discounts, cost of acquiring the product, brokerage fees, excise taxes, and costs for preparing goods for sale, ensuring compliance and efficiency in tax reporting. These tailored strategies help each segment within the industry fine-tune their approach to cost of goods sold optimization, ensuring efficient tax planning and compliance in a complex regulatory landscape. Your entity structure can significantly impact your tax obligations, whether choosing between an LLC or a C Corp. It's crucial to consider how each structure affects your taxation and liability. We'll compare their tax implications through a simple case study. So in the first case study, a cannabis company chose to operate a limited liability company. This structure offered a flexibility in management and allowed the company to benefit from pass-through taxation. As a result, the business itself was not taxed. Instead, profit and losses were reported on the owner's personal tax return. This structure helped minimize double taxation, but also required diligent record keeping to ensure accurate reporting. However, the LLC faced limitations in raising capital due to restrictions on the number and type of investors allowed. Conversely, the second case involved a cannabis company that opted for a C corporation structure. This choice provided the benefits of unlimited growth potential and attracting investments from a broad range of investors, including institutional investors. However, C corporations are subject to double taxation, where both the company's profits and the shareholders' dividends are taxed. Despite the higher tax burden, the company benefited from being able to retain earnings for growth without immediate distributions, providing long-term financial stability. By comparing these case studies, businesses in the cannabis industry can better understand the tax and operational impacts of different entity choices. Engaging with tax advisors and attorneys helps navigate these complexities, ensuring the chosen structure aligns with business goals and regulatory requirements. This always should be like at the very beginning. You need to know your entity structure from the very beginning. So although 280E prohibits credits on the federal side, there are several opportunities on the state level if your state has decoupled and allows for tax incentives and credits. So I'm going to talk about some of the incentives, but this, again, mainly it's on your state side. So you can engage in R&D activities. By investing in research and development, cannabis businesses can tap into substantial tax credits. Innovating new products of enhancing existing ones not only benefits your portfolio, but can also provide significant financial returns through tax relief. Invest in environmentally sustainable practices. Adopting green energy solutions and eco-friendly practices can lead to qualifying for various environmental tax incentives. This not only reduces your ecological footprint, but can also translate into considerable cost savings through tax deductions and credits. In states permitting the depreciation of assets within the cannabis industry, businesses have a valuable tool to further optimize their tax strategies. Depreciation allows cannabis companies to allocate the cost of tangible assets, such as buildings and equipment, over their useful life. This process can result in significant tax savings as it reduces taxable income annually. Taking advantage of state-specific depreciation rules requires an understanding of allowable methods and the types of assets that qualify. Regular collaboration with knowledgeable tax professionals can ensure accurate application and compliance, maximizing the financial benefits of asset depreciation. By fully utilizing state depreciation, cannabis businesses can better manage their financial health and foster sustainable growth. Exploring employee stock ownership plans. I'm going to say ESOPs, and that's what it means. While ESOPs offer significant advantages, they also come with associated costs. So I wanted to mention that businesses must consider before implementation. So despite these expenses, ESOPs present an innovative opportunity for some cannabis companies to foster a sense of ownership and loyalty among the workforce. ESOPs allow employees to acquire ownership interests in the company, aligning the interest of workers with those of the company. This can be particularly advantageous in the cannabis industry, where attracting and retaining skilled employees is essential due to rapid growth and evolving regulations. Implementing an ESOP can improve employee motivation, increase retention rates, and potentially enhance productivity as employees become stakeholders in the company's success. Furthermore, cannabis companies that adopt ESOPs can benefit from various tax advantages, such as deferring or even eliminating taxes on certain transactions. Engaging with financial advisors experienced in setting up ESOPs in regulated industries will ensure that the plan is tailored appropriately and compliant with both federal and state regulations, ultimately supporting long-term profitability and workforce satisfaction. Technology is a game changer in tax processes, enabling efficiency and compliance. Consider AI-driven analytics for assessing tax liabilities and blockchain for transparent financial tracking. Regularly reviewing and updating your tax strategy is crucial as the industry and regulations evolve. Employ KPIs to measure efficiency, ensuring your approach remains effective and aligned with your business growth. Partnering with tax professionals who specialize in cannabis can offer immense benefits. Regular consultations allow you to adapt strategies quickly to new regulations, keeping your tax planning proactive, not just at the end of the year. You constantly plan consultations with your tax accountant. Oh, my clip note 4. Got to throw that in. So my final clip notes is going to be navigating tax compliance for new cannabis startups. So to conclude, I want to thank you for joining this presentation. And remember, an adaptive tax strategy harnessed through the power of technology and expert partnerships is essential for navigating the complexity of the cannabis industry successfully. Thank you. Thank you guys again.
Oh, thank you, Angelita. And all 3 of the Cannabis Clip Notes in the series of 4 by Angelita Green are available on the Women's Cannabis Chamber of Commerce LinkedIn page and all our social media platforms, as well as the Women's Cannabis Chamber of Commerce website. At the first of the year, the complete series will be available on Women Cultivating Success directories. So please stay tuned, and we're going to do the 4th in this series later this month. Again, thank you